I will present to you the news as they actually are, without any falsehoods. Credit Suisse, a top 30 global bank, is considered a systemically important bank that is too big to fail. Despite past crises, Credit Suisse's latest situation feels more real and alarming, with the Swiss central bank ready to bail them out if necessary. With $580 billion in assets, Credit Suisse is twice the size of other failed banks, and its collapse could have a short-term negative impact on global equity markets. The current banking crisis has led the market to reassess what they expect from the American Federal Reserve. The base case that the market is betting on is that the Federal Reserve is not going to raise interest rates next week, and the market is expecting a 1% to 1.25% increase in interest rates by the end of the year. The crisis has also led to more money printing, with the US printing big time, China, Japan, the UK, Switzerland, and the EU also printing. The rise in liquidity tends to bring a risk-on attitude, flooding the system with more money and investors seeing big returns on risk assets, tech stocks, and crypto. However, large global banks collapsing is not good for the market, and this could have negative impacts on equity markets. Inflation fell from 4% to 6%, and the Fed will have to make big calls as more rate hikes could kill more banks. Despite this, JP Morgan believes the Fed could inject up to $2 trillion into the banking sector in the U.S. alone. Fidelity, the third biggest asset manager in the world, has gone live with commission-free Bitcoin trading for their clients. In conclusion, Credit Suisse's current situation is alarming, and the market is expecting the Fed not to raise interest rates next week, but to increase them by the end of the year. The rise in liquidity could bring a risk-on attitude and more returns on investments, but the collapse of large global banks is not good for the market.